All right. Apparently I was hitting the backward button instead of the forward button, proving I'm not as technologically adept as I would like to be. But all right, so what we're going to do is basically I've gone through this. I'm going to talk a little bit about financial market conditions. So we're really going to look at what's been happening in the equity market, largely stocks and bonds. Some discussion about volatility. We're going to talk about where inflation is. And I think because it's in the news, I think it's really interesting. We're going to talk a little bit about the Tesla-Twitter merger, right? And try to give you some views on how likely the market thinks that is going to take place. And it's the probability of a successful merger is surprisingly low at this particular point in time, which I found surprising. I noticed there was an article in the Wall Street Journal this morning saying that Elon Musk has actually lined up like a couple more $1 billion of private investment to help him out with the acquisition. So I would assume that by the end of the day, that probability is probably going to go up a little bit, right? But so that's where we're going to go. This is just simply a chart. And what I did was I said, let's look at the S&P 500 and a portfolio of corporate bonds. And let's track how they did. So what I said was, let's go back. I started in February 22nd, 2021. I said, what if you had invested $1 in the S&P 500 and you held it up through basically last week? What would your performance have looked like? Do the same thing with a portfolio of relatively high yield, not high yield, I'm sorry, but investment grade, sort of good corporate bonds. And how do those two return? How would you have done? Well, if you put $1 in, the market has done quite well. The blue line represents what you would have earned if you held the S&P 500. And one of the things that you can see is that this gray line you see is actually the ending price on the S&P 500 on this index. And you can see that you probably earned about 12% over that period of time. What is interesting to me, though, is how the corporate bonds, how did the bond market? And I think it's particularly important for the bank because they do have a lot of investments, passive fixed income type investments. And so what you can see is that those securities have not done nearly as well, right? The corporate bond market has not done well. And the reason it hasn't done well is because of inflation, right? And what you can see is that the market really starts to go down right around the time, right about here, right around the time when it became clear that the Fed's interpretation of how permanent inflation was going to be changed. Right? The Fed had been telling us inflation was temporary, it was going to adjust, it wasn't going to be around. Market and investors finally said, we don't buy this anymore, that this isn't really a compelling story. And so bond markets go down. Why do bond markets go down when there's inflation? It's because the payments are fixed, right? And so when there's inflation, the rates that investors expect go up, because you expect to be compensated for holding inflation risk. So the returns that I would expect as a bond investor go up so that I can now break even after inflation or earn a fair return after I adjust for inflation. Well, if the payments are fixed, but the rates go up, the prices come down. That doesn't happen in stock markets because there's an expectation, or not to the same degree, because there's an expectation that companies can pass along through higher prices the impact of inflation. So even though the rates that investors expect go up, they're also charging more, so their cash flows go up. So companies can adjust to inflation, at least on an equity holder's basis, whereas a bondholder really can't. And the rates on these bonds have been so low for so long that the idea of variable rate loans just isn't something that you see very much in the market anymore. Now, back when I first graduated from my alma mater, which is Ohio State University, that was back in 1978. And when I graduated from Ohio State, inflation was a real concern, right? I could buy a treasury bond and I could put my money into a money market fund. I was earning 16% per annum on simply treasury riskless securities because inflation was so high. So probably like a lot of the board members, we've all gone through this period where inflation's been really high, and it really changes the way you think about investing. And so Personally, over a long period of time, I've stayed out of bond markets largely for that reason, because as a personal investor, I want to be in equity markets, right? Now, this is sort of a breakdown of the same basic time period, but what we're going to look at now is how do different sectors perform. So which sectors, what parts of the economy seem to do better than others, right? And so what we have here is we have basically 6 different sectors. I'm going to put the S&P 500 in here, and it's going to be hard to see, but it's kind of rolling through the middle, right? And I'm going to have 2 natural resource sectors. I'm going to show you what's happening in natural gas, and I'll show you what happens in the basically oil, right? And so the big orange bar that you see that's spiking all over the place, that's natural gas, right? The one that's right below it that has done really well is oil, right? Well, it doesn't take a genius to figure out where that volatility in the natural gas market has come from, right? That's coming from the Russian invasion of Ukraine and what's been happening in Europe with the restriction of natural gas. And so if you were smart enough to invest in natural gas right at the beginning of the Ukraine invasion, you would have done quite well, found an ETF, for example. The same thing has been happening with oil, but oil isn't as tied to the Russian economy, right, as natural gas. I'll show you in a second. Russia is the number two producer of natural gas in the world, right? So you see that those markets, those natural resource markets, have exploded because the supply for natural gas and oil has really gone down due to this conflict. What I did find interesting is that I put wood up here. It's just another commodity type investment. And wood has really tracked the S&P 500. And that's largely because of the housing market and how well the housing market has done. I think probably in Pascagoula, if you're in Ocean Springs, you've probably watched what's happened to real estate prices in your area. I know in Nashville, it's amazing how fast the market for real estate has inflated and how much property values have increased over the past year. Right? Seems like I must get a letter in my mailbox 3 times a week asking if I want to sell my property. Right? So one of the things that is interesting, I think, is that the sector that has performed the worst is the biotech industry. Right? And I don't have a good explanation for that, right? But it surprised me, right? I think that one explanation might be there's been a lot of biotech IPOs recently over the past couple years, and those IPOs have gone off at very high prices, right? And so sort of think of them as being maybe even overpriced at the time they're issued. And so one of the things that tends to happen in the IPO market, if you've studied the IPO market, is that after a company IPOs, on average, they dramatically underperform the market. So you can, on average, the average IPO probably loses 30 cents in the dollar after 5 years relative to a similar firm. So one of the things that might explain this is that after an IPO and you've had a lot, what you're seeing is people are starting to realize that maybe these companies aren't quite as valuable as we thought they were. And as we learn more about their future prospects for whatever drug they're developing, maybe they don't pan out. A lot of these firms they become less valuable. That's a potential explanation, but at the end of the day, I did find that surprising. This is volatility, right? And the reason I'm putting this graph up is this is the stock market. The blue line is the S&P 500. The green kind of dotted line is something called the VIX index. How many of you have ever heard of the VIX index? All right, so not a lot of us, all right? So what is the VIX index? The VIX index is sometimes called the fear gauge, right? What it represents is a market-based estimate of stock market volatility. So if as somebody has done a lot of work in option pricing, if you look at the price of an option, the most important input into an option model is an estimate of how risky that security is. And so it's called volatility. So you need an estimate of the risk. And so one of the ways that I can actually determine how risky investors believe a stock is I can look at the price of an option and what it's selling for in the market, and I can back out that estimate, that market's estimate of the volatility. On one side, I can say volatility goes in, a price comes out. The other way is to just reverse it, is to say, I know what the price is, let me pull out a volatility estimate. And so that's what the VIX does, is it takes options on the S&P 500 index, and it extracts those estimates of volatility, and then through sort of a complicated averaging process, it comes up with a single estimate. And that trades on the Chicago Board of Options Exchange as a contract, where you can basically go in and buy options on volatility. But one of the things that's nice about it, it does tell us what the market, where the market thinks how risk is going to evolve over time. So as of April 27th, 28th, the level of the VIX was 28% per year. So it was basically saying that the S&P 500 has a volatility of about 28%. Now, over the entire sample period that you're looking there at, that average is about 20.5%. So what that is telling me is that in the current environment, the market believes that we're about 50% more risky than we typically are. So that risk expectations are elevated in the current market. Right? And so you can see this big spike out here. That was when Russia invaded the Ukraine, right? So you can see that there's a huge spike right on the invasion date as market participants tried to figure out what's going on in this market. How is it going to affect the economy? And it really came down rapidly, right? So after the initial invasion and the initial fear of what was going on in Ukraine, people had a better chance to really process what was going on. You see volatility levels came down, but really as the intensity of the invasion has started to ramp up recently, you can see it's now climbing back up a little bit, but not to the invasion day levels. Now, where does this volatility come from? Well, what I did was I did the same exercise. I went out and I said, okay, I know how the VIX index is constructed. So what I did was I said, let's look at these individual volatility estimates from different option contracts. And so what the VIX does is it averages across all these options, but this blue line represents options that expired on May 2nd. The orange line represents options that expire on June 3rd. As you go down, I have options expiring on September, December, and March. One of the things that you can take away from this chart is that what's really causing that VIX index to be so high would be expectations about what's happening in the very near future, right? So the options that are expiring on, in this case, May 2nd, that implied volatility is just an estimate over that April 28th date to May 2nd. So it's a really small time interval, but the volatility is really high over that. And then if you were to go out to June 3rd, that's an estimate of how risky the market is going to be from today to June 3rd. And you can see that it's come down. And every time you go out in time a little bit, it starts to drop out and then it sort of settles down to right around 26%, somewhere in that range. So elevated levels are still being predicted by the market, but there's clearly a lot of that higher estimate is coming from very short-term risk as opposed to longer-term risk. And one of the things I want you to notice is this is really something common in all option markets. It's just more of an aside than an outlook, but you'll notice that on the left side, you see how the line kind of slips downward. What this thing on the left represents is it represents volatility on out of the money put options. And a put option is like buying an insurance contract. Right? So if you don't know anything about options, if you just said, when I buy a put, I'm basically buying insurance, what it's saying is that people are paying a lot of money for that insurance. Okay? And so that's what's really driving this spike over on the left-hand side, is that people are paying for insurance. And a lot of option traders make a lot of money trading on that. Right? So there are a lot of professionals who basically sell those puts to people who want the insurance. And it's a really good strategy as long as something really bad doesn't happen in the market. And when something bad happens in the market, you lose a lot of money as a put seller. But up until that point, you can collect a lot of money. All right. All right, so now I'm going to just sort of pivot just a little bit, and we're going to talk about other people's estimates of markets and where we think the level of the stock market is today. Is the stock market basically trading at what investors perceive to be at a fair level? Is it overvalued? Is it undervalued? I'm going to show you two metrics that suggest that right now the market is overvalued. Right? And the first one is something called the Buffett indicator. Right? The Buffett indicator is a little bit like a price-earnings ratio. What it does is it takes the market capitalization of all stocks, and then it divides by GDP. Right? So kind of like an income measure on the bottom, GDP. And so when that level is high, it means investors are paying a lot of money for the current output of the US economy. Right? And so this line sort of takes you through this, and here we are, this red dotted line represents something that's likely to happen less than about 1% of the time. All right? So by random chance. And so what you can see is that this spike, this right here on the chart, that is the dot-com bubble, right? That was the height of the dot-com. So this chart goes all the way back to 1950. But at a point where I think we can all look back with hindsight and say there was a period when stocks prices seemed to be unrealistically high. They crashed. The bottom of this line right here, this sort of peak, the bottom of the chart, that's the height of the financial crisis. Right? And you can see that subsequent to the bottom of the financial crisis, the stock market, the relative valuation has been going up, but what we can see is right now we're operating at a point that's well above historical levels, which to people who like this Buffett indicator, that's a signal that they believe that the market is basically overvalued right now. Sort of reinforce that point, this is basically the price-earnings ratio, if you will, for the S&P 500. It's the market capitalization of all stocks in the S&P 500 and divided by earnings for all stocks in the S&P 500. And what you can see is a really similar picture emerges. It almost looks like I just relabeled the figure, right? That what we see is during the internet bubble, it was at the peak. At the bottom of the financial crisis, it was at the trough. And today, we're well above where we have been historically. So if you're looking at both of these, we're either about to be overvalued or we are overvalued, right? So, I basically, if my view is I'm probably pulling out of markets a little bit, right? And I know personally I have, right? So, and it's largely because I do feel that there's something going on here that I don't quite understand, but I do think that markets are a little overvalued. All right. Now, I thought one thing that would be fun to ask or to look at would be what's going on with sort of non-traditional asset classes, right? So one of the real advantages of investing outside of the stock market isn't because you have an opportunity to earn really high returns. What these other asset classes tend to be very good at doing for you as an investor is reducing risk in your portfolio without sacrificing a lot of return. So as an investor, that's what I want to try and do. I want to maximize the return I can earn, but minimize risk that I have to take at the same time. So if I can put a certain asset into the mix that does a really good job of getting rid of risk, that's going to be a valuable asset. And I don't have to earn a big return on that asset to make that valuable in my portfolio. So gold is one of those long-standing alternative assets that does that for investors. Commodities have become a really good diversifier as well. Right? So there are a lot of managed futures products out there that invest in commodities that are very successful at getting rid of risk. But you can see that this isn't without risk. So whereas gold, so this orange line that you see on that figure, that's Bitcoin. Clearly an alternative asset class. Right? I saw in the journal this morning, Fidelity is trying to figure out how to allow investors to put Bitcoin into their 401k plans. Okay, I'm not sure what I think about that. I mean, I don't mind. I've invested in crypto, right? So I mean, I have some Ethereum. I've some ETH right now. I've had Bitcoin, so I'm willing to hold it. But I view it for what it is. It's a super speculative investment, right? You better be willing to lose everything. And to show you how you can lose everything, when I first bought a stake in Ethereum, within a month, I had 10 cents on the dollar. I mean, I thought this is the dumbest investment I've ever made, right? I literally lost 90% over a period of a month and a half. And I just threw it in the, okay, I'm forgetting I even own that, right? And just held on to it. And of course, now it's way above what I paid. But there's a period where I thought, why did I ever do this, right? I don't know anything about this asset really, other than I like the blockchain. And so there's a lot of risk with that. And this orange line shows you just how volatile this could be. So over a period where the S&P earned about 12%, or about, actually, what was the number I have? I wrote it down here. Over this period that you see on this chart, the S&P is only up about 4%. Bitcoin was down 12%. Gold was up 6%. So there's some interesting differences in how these assets perform over time. But I don't think crypto is for the weak of heart, right? It's a bad investment for most firms. All right, now, here we have, this is Tesla and Twitter, right? So what I want to do now is we're going to talk a little bit about what's going on with Tesla and Twitter. I just want to quickly go back. Okay, yeah. Okay. So on your left, what I've done is I've said, what happens if back in February 22 of 2021, you put $1 into Tesla and you put $1 into Twitter? Where would you be as of yesterday? Right? And so what happens is you can see that Tesla's done quite well, right? It's a risky investment, but Tesla has gone up pretty effectively. It's done better than the market as a whole. Basically, you'd be up about 23% if just on adjusted return on Tesla. If you had invested in Twitter, you would have found that you lost about 23% over that same period of time. So Twitter has been an underperforming stock, right? And so Elon Musk announced he didn't like, right? You're familiar with the story, right? Doesn't like the constraints that Twitter's placing on your ability to speak. Probably doesn't like the fact that certain individuals have been kicked off Twitter when not really, and so at the end of the day, Elon Musk stepped in and said, I'm willing to think about buying it, right? I want to open up the platform a little. It's a traditional leveraged buyout. Elon Musk is going to put a lot of his own capital up, but a lot of money is coming from borrowing. And actually, a lot of the borrowing is going to come from Twitter's balance sheet. So the way he plans to finance this is it's about a $44 billion bid, right, which is about $54.20 a share. He's going to put up about $21 billion of his own money. He's going to use his Tesla shares as collateral to obtain loans to get about another $11 billion. And the difference of about $10.5 billion is going to come from loans that he takes out using the assets of Twitter as collateral. So he'll be able to finance that deal, and he's offering to pay the $54.20 cash price. So what I did was I said, all right, well, I'm surprised because if it's $54, it's trading at about $48. It was trading about $48 yesterday. If Elon Musk is willing to pay $54 a share, but the market only values it at $48 a share, it's pretty clear the market doesn't think this is a slam dunk deal that's going to go through. Because if the market really believed that it was going to happen, it would probably be trading really close to $54. So why isn't it trading that closely to $54? And a lot of this, I believe, is just the expectation that maybe some of this financing is not going to work out, that Elon Musk is going to pull back. He's not obligated to go through with the deal. He may just decide he's made his point and walk away. He's a mercurial figure, right? You really don't know what he's going to do from one day to the next. So what do you think is going to happen? Well, I went back and I went through all Elon Musk's tweets, right? And I found the first day that he said anything at all about Twitter in his tweets. And I said, that's the point where the market should have first become aware that he was going to do something with Twitter. And the stock price at that time was about $39 a share. Right? And so I basically said, if you think the price is going to be 54 and it's only trading at 48, the difference between those two prices has to reflect the probability that the deal succeeds. If the probability of success is 100%, it ought to be trading at 54. If it's trading at 48, I calculated the actual probability of a successful takeover is around 68%. That seems remarkably low to me, right? For something that I think is a lot more likely to happen, right? So in my view, I would say, Twitter probably looks undervalued given what's going on with Elon Musk at this particular point in time. Just an opinion, okay, but that's kind of where we are. I only have 5 minutes. 10, proves I can talk as long as you want me to. All right, so we'll speed up just a little bit. But I thought that was an interesting fact. So let's go through this. I think inflation is a huge deal. To me, inflation is the biggest single risk that is facing our economy right now, bar none, right? And if I'm Merchants Marine Bank, it's the biggest risk I face from an operating standpoint. What's going to happen? How am I going to be able to blow money? What are the rates I charge? What's going to happen to my asset portfolio? So I think that what we're going to see is I think we're seeing sustained inflation for a long time. I don't think it's going away. I think we're just going to have to recognize that the massive amount of government spending that has taken place is going to cause a lot of inflation. That bill is going to come down. Inflation. Right? And so a lot of it comes against some tax increases. Right? I think we're quite not surprised. I would expect the Biden administration to propose a lot of tax increases. One of the reasons we have inflation, although that might have been more temporary, is just the pandemic support created a lot of demand for goods and services because it was handing people money, but no one was working. And so problems with the supply chain meant there were a lot more people who wanted to spend money than there were goods available to buy, which of course, how do you react to that? You raise prices, right? So you're seeing that you're having to pay people higher wages. We have really low unemployment levels. There's been a lot of talk about the Great Recession, the Great Resignation. That looks a lot like job switching to me, as people move from one lower paying job to a higher paying job. I think that explains a lot of the Great Resignation. But I don't know about people who are in my vintage, but a lot of my colleagues are retiring, right? Years before I would have expected them to retire, right? So there is truly, from people 55 and older, there's truly a lot of people just leaving the workforce permanently. Housing costs are going up. I think there's an inadequate investment in energy infrastructure. All right, so let's talk a little bit about inflation expectations. So what I've done here is I've just sort of plotted treasury yields. And what you can see is that treasury yields have been pretty low for a long time, but they're starting to spike. They've been around in a range of 2 to 3%, which compared to what it was 2 years ago, look pretty attractive. One of the things that you can do with a treasury yield is the biggest thing that determines the yield on a treasury bond is inflation. There's almost always a small real return, but most of the return that you earn when you buy a treasury security is basically protecting you for inflation risk. And so there are two types of treasuries that exist. There's one called a TIPS, which is an inflation protected security. And that security its principal is adjusted so that the yield on that is only the real return. The way it compensates investors for inflation is by changing the principal or the face value. A regular treasury bond includes both a real and the inflation adjusted return. So if you take the difference between those, there's an estimate of inflation. So what you can see is that according to the treasury yield, treasury market, inflation today is expected to go up to about, let's say in the order of 3.5% over the next 5 years, and then drop a little bit. That is as of last week. That does not comport with sort of every other thing I'm hearing about inflation and how inflation is likely to be. And one of the reasons why I used to use this all the time, but I'm less inclined to go this direction, is because I think monetary and fiscal policy is artificially keeping those treasury yields low. So it's no longer that reliable indicator of inflation. So what I did is I just calculated inflation using the CPI. And if you use the CPI, this blue line represents what the government releases. It's about 8.25%. So the treasury yield estimate is 3. The CPI index tells you it's about 8. The way the CPI is calculated is you take today's CPI and you divide it by, you calculate the change relative to a year ago. So I said, let's just look at it with a little higher frequency. So I did it on a quarterly basis. And I just went back and recalculated as though I calculated on a quarterly basis. And what you can hear, if I just use a quarterly version of the CPI, inflation over the next quarter was expected to be over 12%. And that seems a lot more in line with what I think a lot of people are experiencing. So there's a short-term phenomenon that inflation's really ramping up. All right, so risk and geopolitical factors. I don't have a lot of time, so I'm not going to spend much time with this, but what this represents is there's a market that trades what are called credit default swaps. And these are securities that pay off if the underlying country, in this case, can't pay off their government bonds. Right? And so what you can see is that if you were to invest in a credit default swap for Greece, the market thinks that there's about a 2.3% chance that Greece will not be able to pay its bonds. If you look at China, there's less than a 1%. There's about a 0.9% chance that people feel that China won't pay off its bonds. Canada, 0.54%, right? So like almost 0.5%. The US, 0.25%. Russia, 100%. Right? The probability that Russia couldn't pay its bonds off prior to the invasion was right around 3.5%. So there's a huge change, and Russia's basically defaulting on its bonds now. Interesting, if you looked at Ukraine, their probability of default, according to the market, has not changed throughout the Ukraine invasion. It was about 9% before the invasion, and yesterday it was about 9%. So for whatever reason, the market doesn't think there's a, it's like not a certainty, but the invasion hasn't affected the investors' perceptions of Ukraine's ability to repay as much as it did Russia's. All right, so I put this in because I heard there's some high school students in the room. And so what I wanted to do is just this is like sort of some interesting facts, right? And so this is Russia, right? So Russia has and I wanted to compare it to the US, just so you could have kind of a benchmarking exercise. You might find some of these facts interesting. So Russia has about 145 million people. Right? The US has about 332 million people as last date. So the US has about 2.28 times as many people as Russia does. It almost flips in terms of the size of the country. And the land mass of Russia is 6.6 million square miles. Right? The US is only 3.8 square miles. And the GDP in Russia is 4.3 trillion. The GDP in the US is 25.35 trillion. So the US has about twice as many people, but about 5.5 times as much GDP. We are a much more productive country than Russia on a per capita basis. Basically, Russia is a little bit like, it's a third world country with nuclear weapons. That's really what it is, right? And its real outputs are natural resources. It has 10% of the world's oil reserves. It's the second largest natural gas reserves. And it's a key exporter of some important elements, nickel, cobalt, and aluminum. All right, China. So what are the big risks? Well, obviously, we have basically what's going on in the Ukraine, sort of causing disruption. One of the things that's understated, and there's a tension to it, is I think cyber threats, right? There's a lot of hacking that goes on in Russia directed at the US, and I think that's one of the big threats that that companies in the US face is due to sort of hacking that's supported by the state. All right, so let's look at China. So what is going on in China? China has a population of 1.4 trillion people, right? Trillion, right? Billion. There's a typo. Yeah, we don't have quite that many people. It'll only be a few years, but no, actually China's population is going down. Right? China has a real problem with population growth because of the policies they've had around the number of children you're allowed to have. It's really created a lot of males relative to females because of the Chinese culture. And so they're going to have a really hard time sustaining their population as that population ages. It's just a matter of time before China, I think, is in real trouble. Right? But right now, China is about 4 times larger in population than the US. But it's about the same size in terms of square miles. So it's about the same size country, but they have 4 times as many people. And their GDP for the entire country is only about $20 trillion compared to the $25 trillion of the US. So once again, on a per capita basis, the US is so much more productive per capita than either Russia or China, right? But China's GDP is the 11th largest. Believe it or not, it's the world's #1 manufacturer, right? It surpassed the US back in 2010. It's the #2 high-tech manufacturer in the world. It has a really large retail market, and it's the world's leader in electric vehicles and batteries. So give you some idea where they're headed. They're having problems internally, right? I mean, so they've really redirected how they've invested. China has 5-year plans. They have state-sponsored investment. The investment subsidizes particular industries, right? So what's happened in China is one of the industries they were subsidizing was housing markets. And you can see some of the problems that have taken place in China with respect to a lot of their housing. And so they've really scaled back on that housing market growth. And they're also cutting back on a lot of their actual investment in infrastructure. The real problem I see with China is cyber risk. And that's I think there's a long history of China basically stealing US intellectual property, right? It's not something that, as we talk about, it happens, right? And so there were a lot of instances where US manufacturers could see, like the bullet trains that China developed were completely stolen from plans that US producers had put together. And so a lot of China's growth and its manufacturing has really come at the expense of weak cyber protection in the US, as Chinese nationals were able to extract intellectual property from these large companies. All right, so in the interest of time, I'm just going to say cyber risk is a problem. The average cost of a data breach in 2021 was $424 million per company. Right? Of particular relevance to the bank is that the average cost per record that's stolen is about $161. So if your customer database is stolen, the average cost of the bank is going to be about $161 per customer. This is just a chart that shows what the average cost data breach by industry. In the financial industry, which is the second bar up here, it's about $5.72 million per breach, right? So in 2021, it's about the same in 2020. So it's expensive, it's a risk. There are some things you can do to worry about it, but I'm gonna skip now to some value, sort of close my remarks off, Casey, with some discussion. So what I did is I want to see just where does Merchant Marine sit relative to other community banks? So I took a list of the largest community banks that I found online by asset. I took the 50 largest community banks and I tried to see whether there was financial data available on them. And I found data, public data, on 29 of them. A lot of them are private, aren't traded. A lot of them don't file anymore. But of these 29, this is the list of companies that I could find. So if you can read that from the back, good luck, but it's just a list of the firms that I used to put this analysis. I'm going to show you two metrics. I'm going to show you something called price to book, and I'm going to show you what the price earnings ratio looks like compared to these competitors. Price to book is basically how much is the market paying for $1 of book value. Book value should be, in my mind, the floor that a company should trade at, right? It should trade for more than its book value. It's basically saying if it trades for less than its book value, that in theory and principle, you should be able to liquidate the assets and get more money than the market is currently putting on the bank, all right? So here's that orange bar is Merchant Marine Bank. It has the lowest price to book ratio of any of the 29 competitors that I identified. That ratio is 0.63. Means I'm paying about 63 cents for $1 of book value. In theory, I think you could liquidate the bank and get more than that. So this is a story that at some point needs to get told, right? This is why I will buy shares in the bank. If this is like the Warren Buffett dream. If you are a value investor, this is a pure, clear value play. And you can see that there are a few other banks that trade for book values below. This line right here represents one, but almost all the other competing sort of community banks trade at prices well above their book value, right? So, and given the balance sheet and kind of what's going on in the bank, there's a real story to tell, right, that hasn't been told yet. Now, one of the things that is interesting is that while a low book value signals underpricing, this is the price earnings ratio. And I put it on a scatter plot. So we have price to book here, and we have the price earnings ratio here. And up at the top, the square, that's you. You have the largest, highest price earnings ratio. So now it's kind of conflicting, right? On one end, it looks like it's really undervalued, but if you're just looking at a price earnings ratio, it looks to be significantly overpriced relative to its peers. So how do you reconcile those two differences? Well, if you were to, for example, I think one of the things that happened in 2021 is there was a lot of cleanup that took place, right? There was a lot of underperforming loans were sold. I mean, a lot of level setting took place. There is also a significant investment in what I would call intellectual property, right? Or soft infrastructure, right? Building up your human capital component of the bank. And that was expensive. And so that depressed earnings in 2021. And so when earnings go down, the price earnings ratio goes up. If you were to just use last year's earnings level and assume that nothing else happened, but just use last year's earnings level, you are right in the middle, right? So I do think that this investment that has taken place in human capital has caused the price earnings ratio to look high, but I don't view that as something I would be concerned about, because I think the real story is back here with the price to book ratio. That's the metric that I would be focusing on. And if I just thought about why when I went through and looked at the bank, and I wasn't really familiar with your firm, your company before, right? But it's really conservatively capitalized. Like, this is a really solid bank from a financial perspective, right? Its capital ratio is way above what regulators would require if you were a regular bank holding company, right? So it's a very conservatively capitalized bank. It has a lot of liquid assets on its balance sheet. So it looks very solid from a capital structure standpoint. One of the things that I thought was really interesting is this financing arrangement that you're about to enter into, where you're going to basically enter into an arrangement with Treasury where you'll have preferred stock. And this preferred stock, the cost of capital associated with that preferred stock investment is so ridiculously small that it is just a pure subsidy. I mean, I would take advantage, I would get as much of that action as I could, because it is a real deal, right? And it's really a good strategic decision for the bank to be doing it. And the amount that you actually pay is conditioned on how many loans that are made. And the more loans that are made relative to a base level, the actual rate that goes down, but the maximum rate, what, Casey, 2%?
Well, yeah, maximum for.
Yeah, and which for perpetual stock, 2%, preferred stock, that is a huge bargain. I would think that in an open market, you would have to pay well in excess of 7 or 8% for the exact same financing arrangement, right? So it's basically free money, right? And it'd be silly to pass on it. So thank you very much. Those are my comments for the morning. So appreciate, again, the opportunity to talk to you all, and look forward to answering a few questions.
We will take about 10 minutes at the conclusion of the presentation. I think we've got one more slide here.
Nope.
So what we want to do to be respectful of everyone else's off. If you were going to construct a financial model to predict what might happen to the U.S. economy for the next 12 months, what 3 indicators would you want that model?
So, all right, so the question is, if I were going to build a financial model, what would be the 3 indicators that I would use? So I would want to have some measure of inflation would be one of my factors that would go into the model, and that would, I think, be the most important. I would want something, though, on the supply side. So I would want something around probably GDP, right? Just some metric of production. And if it were me, because I'm really worried about risk, I would probably include some metric around risk as well, something like the VIX index or something like that.
So inflation, GDP, VIX.
Yep.
Okay. With regards to government stimulus intervention into the economy, student loan debt has been a hot point politically. The forgiveness of that debt would seem to create significantly more liquidity injected in the economy. Do you see that spurring on additional inflation if it does come to fruition?
It's an interesting question because you have to ask the following. You have to ask the following point, right? Is that how much of that student loan debt is already delinquent,
Sure.
right? So there's a huge chunk of it that isn't being repaid already. So the forgiveness of that probably isn't going to do much to the economy because those people weren't actually spending it on repaying their student loans. So the only people that are going to be freed up are the ones that were actually paying off their loans. So I don't think it'll have as big an impact. And if I can get on a soapbox, I think it's immoral, right? To me, it's like you take out a loan, you should repay your loan, right? It just bothers me that the government wants to step in and say, guess what? Everybody that's really done their job, paid off their loans, you're going to pay off the loans of those that didn't take their obligation as seriously. That just bugs the hell out of me. Sorry.
We're very big fans of, we're all certainly very big fans of people paying off their loans. We have another question from the audience, and I'm going to tailor this just a little bit. The question is, how bad is it that the debt in the U.S. is higher than GDP? But I want to ask a little bit different of a question. How bad is it that the sovereign U.S. debt is, 9 times U.S. GDP?
Well, I think that's fueling inflation, right? I mean, I think that the idea that we're going to continue to borrow against the future is what's going to make for inflation persistent for a long time.
Yeah, it's
like we can't, you can't basically spend beyond your means in your personal life.
No.
Right? So I don't know why the government is allowed to overspend as well.
Sure, totally agree. Let me get back, and I'm sorry this takes just a bit to update. How does Merchants and Marine Bank and Merchants and Marine Bank Corp get the word out that our stock should be a very desirable purchase by investors?
I think that's going to be a challenge, right? I don't know how you do that. I think if it were me, I would make sure that all of the programs that I'm really interested in building out are underway. And I don't know if there are investor conferences. I know the way that larger public firms get the message out is they attend investor conferences and they make presentations at investor conferences. My concern is you don't have liquidity to probably really want to jump into that space.
Sure.
Right? Because you actually need to have enough shares trading in the open market to attract an institutional clientele.
And just to be clear, when we talk about liquidity, we're talking about liquidity in our shares.
In your shares, not bank liquidity, but actually share ability to, if I want to buy a share of stock,
Sure.
I want to know that I can go in and I can actually buy it.
Absolutely.
If I want to buy a share of Robinhood, I'm going to be able to buy a share of Robinhood, and I can buy it at as large a quantity as I want.
Sure.
Right? I don't think that that's the case here because I just don't think there are that many shares that are actually available for trading at any moment. And really, that's going to be the tough part.
Sure, absolutely. You said that you are inclined to take money out of stocks. You've shown that bonds have underperformed, and you've illustrated the risks of Bitcoin, and you predicted rising and lasting inflations. I did not ask this, by the way. This is not pick on the professor time. So other than Merchants and Marine Bank, where are you putting your money right now?
So I'll be honest. So look at me, right? I'm 65 and I'm thinking about retirement, right? And so to me, I'm in a lot of liquid assets right now, right? So I'm still in the market, but I am much more heavily, I'm basically a money market fund.
Sure.
Is the way I'm looking at it, right? I have a lot of treasury securities in my portfolio, a lot of short-term treasuries because I avoided what I thought was the long end of the yield curve because I just felt like inflation had to increase. So I've really stayed in really short-term treasury bonds because they will be the first to move with inflation. So I have a lot of assets in treasuries, but I still have a lot in equities as well, but not nearly as much as I did 20 years ago.
Absolutely. we've got, and we'll talk about recent events at the bank and the way that we're investing, and Clayton will cover a lot of this in his presentation. Our first quarter earnings release is out there, so I'm not going to tell you anything that's proprietary or that's privileged information. But what we did last year is we had an enormous amount of cash float on the balance sheet of the bank through the consequences of government stimulus intervention into the COVID and political items that came across the desk and things like that. But we were encouraged by a lot of people. We went to conferences and all we heard was go out on the curve, grab yield, go out on the curve, grab yield, bolster your earnings, which you said it, we had some depressed earnings last year. It was intentional. We had budgeted for it. We could have bolstered that through going out on the curve and grabbing that yield. We would be paying the penalties for it right now.
Absolutely.
Good decision, bad decision.
Great decision. Well, it validates my decision too, right? So.
I waited on the last answer before I asked that question. Yeah.
But no, that was my thinking too.
Yeah. It's interesting, and like I said, I know Clayton's got a couple of bullet points about that to illustrate the validity of that decision and kind of what we were thinking. It was nice to be validated by it, but it was certainly a difficult decision to make at the time.
Yeah,
because,
I bet.
you always want the income, right?
Yep.
Apologize. Do we have any? I've got one more. How high do you think? And again, this is one of those crystal ball questions, right? And I apologize, but how high do you think interest rates on loans could go up due to inflation?
So tell me what your loan is now. What is your average interest rate that you basically are charging on a loan?
It depends on credit risk and things like that. I'd say average commercial deal probably in the fives.
Fives. So my guess is you could be up as high as 8.
Wow. And we're seeing that in the yield curves, right? And
That's
pricing
right.
in for an assumption of a Fed funds rate at about 2.5%.
2.5%, but you're seeing what the actual inflation rate is double digits right now. So
Yeah.
that gap has to close at some point.
Once perhaps it starts eating through cash to the
Yeah.
point where people need leverage again.
That's right. And it's not going to close by the inflation rate coming down as much as it's going to close by the federal fund rate going up. And you can already see that there's significant talk about staged series of increases in the federal funds rates that are taking place.
Well, unless there are any objections, we'll close. I'd like to offer you a big thank you both professionally for coming down, for being willing to join us for this event, and personally for everything that you've done for me. I think I'm not out of line in saying that without the learning that I got from you, I wouldn't be equipped to do the job that I'm doing today. It's very heartfelt that I say you were certainly highly impactful in my career and in my outlook on life. And I just thank you for being willing to come down and join us.
Well, thanks, Casey.
Absolutely.
And I appreciate those comments, but I do want you to know you've picked up a real gem with Casey Hill. Casey was my best student that year. Yeah, absolutely top of the class. And so
I'll give you that $100 bill later.
Good morning. Hopefully, I tend to be a little loud, so hopefully y'all can hear me okay. If I'm talking over here, is that good? Just want to say again, welcome and thank y'all so much for being here to join us for our 2022 annual shareholder meeting. Again, my name is Clem Legier, and I have the privilege of serving as President and Chief Executive Officer for both our holding company, Merchants and Marine Bancorp, as well as the subsidiary bank, Merchants and Marine Bank. I do want to take a moment and thank Royce for all that he continues to do. We are very blessed to have a leader that has the sort of staying power and integrity of Royce Cumbest. Also want to take a moment and recognize, if you notice a lot of youth amidst us, that is by design. We're very thankful today to have high school students from throughout our home county of Jackson County joining us. I do want to point out for these students that are here, they're going to be going back to state testing after this. So they were very kind and generous with their time, as was their school leadership, and allowing them to join us today. And we very much appreciate y'all being here. Thank you for the time. And I hope also that we're able to at least inspire one or two of you guys, if we can't get you all, to think about a career in banking, as well as, even if it's not banking, we hope that you decide to live, work, and play in Jackson County long term. Go off, get your education, and we hope that you come back here to help us continue building this area up toward its full potential. So with that being said, I'm going to walk through, as we typically do, an overview of what our bank accomplished in 2021. We're going to look at a few broad categories. We're going to talk about our financial performance. We're going to add some color commentary, what we've already put in the annual report in terms of what we put in the earnings releases. We're also going to talk about some of the team's key accomplishments. And again, let me make this clear. This is not me. This is the results of a very well-trained, very well-equipped, very talented team of bankers at all levels, not just at the executive level, but even on the front lines. We are very blessed to have an incredible group of men and women who commit themselves day in and day out to making our bank the best it can be, and in turn, making the communities we serve the best they can be. We're also going to talk about some of the headwinds that influenced our 2021 results, and then we're going to pivot, and instead of looking back, we're going to look forward. We're going to talk about what we have on the horizon for the remainder of 2022. We're also going to touch on some big ticket items. Though you may have heard alluded to a little earlier, the Emergency Capital Investment Program. We're going to do a quick refresher on that, and then we're going to take Q&A with that point being done. So in terms of questions and answers, we encourage questions and answers. We do have several folks that are joining us via live streaming. We appreciate them taking the time out of that. As you guys may or may not know, our shareholder base is increasingly not located here. We're very thankful for our local ownership, but we have shareholders all throughout the country, and we welcome those who are joining us via live stream. So to help make sure that all questions get asked, we do have a live text option. If you will text your questions to that number, if you can't see it on the screen here, I know it's kind of small when you're in the back. There is a TV on your right side that has the same number. Please jot that number down. If you have questions throughout the conversation or throughout the presentation, text them to that number. You can also text them in the end. Of course, if you're here, we certainly want to entertain questions from the crowd, and we will. But that helps us make sure that all questions get surfaced and answered. And without further ado, let's go ahead and jump into looking backwards. Our team knows this is not something I especially relish. I'm more of a forward-looking sort of guy. Hey, it's great what we've done yesterday, but what are we going to do tomorrow, next week, next month? But let's look back. And as we begin looking back at 2021, I hope to set the stage by talking about what we're going to phrase impact factors. There's 6 overarching themes that really influenced our performance, our decision-making, and the results for our company in 2021. Now, I know we're all burnt out on the term transitory, right? We heard the Fed say transitory over 2020 and 21 talking about inflation. What's going to go away? That means temporary. So some of these impact factors are hopefully going to be transitory in nature, while others may be more long-lasting. The first we'll start with at the top is the changing tone of the bank regulatory regime. So we know how this process works. We elect a new president who is elected on a platform and policies and priorities. That president then comes into the various agencies in Washington, and they install their people to carry out that program of work and those policies and those priorities. And we really saw that begin changing in 2021 as new appointees or acting interim appointees took the helm of the bank regulatory framework in Washington. It's a blend of oldies but goodies. It's kind of like a really good radio station. They're bringing back some things from the past that we've known about, that we've always had on our radar, things like fair lending, making sure that we don't discriminate against anybody for any reason, except they're modernizing that to say, well, hey, we're no longer going to look at this loan file versus this loan file, but we're going to take tens of thousands of loan files from your bank, drop it in a big pivot table, and we're going to analyze everything to look for disparate impact, even if you didn't intend to discriminate or want to discriminate. So we have those sort of oldies but goodies, and we have some new ones that we're contending with, things that you're probably hearing about: ESG, environmental, social, and governance. So how is our bank impacting the environment? Are we impacting the environment positively or negatively? Where it's getting really interesting is there's a growing body of consensus in Washington that we should not only be accountable for our own environmental impacts, but our banking industry should be accountable for the impacts of all of our customers on the environment. So if somebody's building a house, or if they have an automobile plant, or if they are buying diesels versus electric, there is growing consensus in Washington that there should be a requirement on banks to tabulate that and factor that into our own regulatory assessments. So we're dealing with those sort of factors, as well as diversity, equity, and inclusion. And that's more internal. And that's something I hope that you see we take seriously anyway. We don't do that because somebody in Washington tells us we need to be diverse in our staffing or we need to be inclusive. We do it because we think it's the right thing to do. We do it because we want to be reflective of the communities we serve, and we think a diversity of thought reduces risk and improves performance. The other theme that I want to touch on is the growing prevalence of blockchain, cryptocurrency, and the metaverse. So if I had put this chart up or put this slide up a couple of years ago, we'd all be shaking our heads saying, what is all this cryptocurrency? This isn't going to have any legs to it. It's a bunch of hocus pocus. But we know now that I would do a show of hands, but I bet most of you in here have heard of blockchain. You've heard of cryptocurrency, and increasingly you're hearing of the metaverse. This is a complete replaying, if you will, potentially, of what we know as our financial regulatory framework in our country. I don't know that this goes away. I don't think this is going to be something that changes in 4 years if you get a different regime in Washington. I think this is something that's going to be lasting, but it's forcing us to reevaluate the way that we connect with our clients across multiple platforms, the way that we process payments. If you're able to process payments in a cryptocurrency versus having to initiate an ACH or a wire transfer with us, that completely boxes us out of the equation. Similarly, if you are buying assets in the metaverse and you want to get a loan on that vacation house in the metaverse, how does that impact us? What do we need to be thinking about to be ahead of those themes? And just for funsies, blockchain was created. Blockchain is the system of record that governs all this. It's the foundational technology that enables cryptocurrency. It was created in 2008, so still very, very new. But from 2013 to now, if we're looking April 2013, total assets invested in cryptocurrency, total dollars, 1.7 billion. 2013, 1.7 billion with a B. If you look at that same number today, what is the total dollar amount of cryptocurrency assets in existence? That number has grown from 1.7 billion to 1.7 trillion with a T. Significant growth, significant growth. And that is growth without any sort of push from a governmental entity. Our government hasn't come out and said, hey guys, we're going to embrace this. This is all organic sort of groundswell growth. So I'm not going to talk about this anymore, but I do want you to know we're aware of this. We are monitoring this, and this is something that is factoring into our future thoughts and plans of the company, but it is impacting us now. Now, things a little less esoteric, things that you have all dealt with, that you probably have fussed. If you're like me, Megan hears it all the time. I fuss about it. We can't get what we want from the store because they're out of stock, or we want to order something and it's just not there and they don't know when they're going to get it there. Or you go somewhere to be served, maybe a restaurant, or maybe you go to a home improvement store somewhere and you can't find anybody to help because there is nobody. These same names are impacting us in a very major way. So supply chain disruption is not only impacting our bank in the way of construction projects that have been delayed and drawn out, it's impacting our clients. It's impacting folks that need those inventories to be able to make sales. It's impacting the people that want to buy the goods because they need that truck, they need that piece of equipment, they need that microchip that may not come in for another 2 years. They need that to make their business successful. These are factors that are impacting us. The labor force is a very interesting one to think about, and I know we're all tired of hearing that. We just want somebody to take our order in the restaurant when we go. We want, in banking, we want to have all of our teller windows full. We want to hire. We don't want there to be vacant positions. But the reality is there are now, for every person available to work, there are 2 open jobs. For every person that's available to work, there are 2 open jobs. The number of unfilled vacancies totaled 6.9 million at year-end 2020. Unfilled vacancies in the U.S., 6.9 million. It is now over 11 million unfilled job openings in the U.S. There are no workers. I can tell you anecdotally where we are seeing the greatest pressure and most difficulty in filling positions is on our frontline staff. And that is unfortunate because those men and women are the face of our company. It's all well and good for me to get up here and do this once or twice a year, But those people that are on the front lines are interacting with clients all day, every day. And when they're not there, or whenever those clients are having to wait longer to be taken care of, there's real frustration. And we're frustrated too. We want to find solutions. And so that is something that has hindered us as we move through 2021. While I'm hopeful that we'll see some relief on this front, the reality is the U.S. population is somewhat of a barbell. We have a big group of baby boomers that if they haven't retired already, they're either at or near retirement, right? They're going to be exiting the workforce. We have a smaller group by definition of Gen Xers in between, and then we have the millennial generation to which I belong and Gen Z that's coming after. We have somewhat of a mismatch in the workforce, and we also see people taking other options for work. Instead of working as a bank teller for $13 an hour, they're saying, hey, I'm going to do DoorDash, I'm going to be an Uber driver, and I'm going to make more money doing that, have more flexibility than I would have working in the bank. Those are very real constraints we're dealing with. It's also interesting to note that of the total positions that are available in banking, only 55% are being filled right now, industry-wide. Now, we're thankful our turnover metrics, all of our metrics in-house are far better than peer. Our turnover is way lower than peer. It may feel like a lot here because we benefited for so long from having a very stable employment base. We've had people that have been here for 30, 40 years, and that's a blessing. But those people in some cases are saying, you know what, I've been there 30 or 40 years. I want to go play with the grandkids. I'm going to go do something else. And that's good. And we cheer them on. So I know that it may feel a little different, but that's what we're contending with. But we are thankful that our results and that our metrics are far better than our peers. Last two factors, and Dr. Lewis did a wonderful job hitting these. So I'm not going to spend a whole lot of time on these on this slide, but bank balance sheets nationwide are bloated. In 2019, our industry as a whole was struggling for deposits. We had very strong loan demand. The economy was good. Everybody wanted money. And we were scratching our heads. I'm looking at some of the people that we were scratching our heads with. Jimmy Conyers, our Alabama market president in the back, thinking, well, how do we get deposits in the door? How do we get deposits in the door? And so we were doing things like CD specials to try to move somebody off center and get them to bring the deposits over. And little did we know, we were asking, gosh, we really wish we could get some deposits. And, Jimmy, it's ironic, from March to about June of 2020, we got more deposits than we knew what to do with, thanks to the federal stimulus. And so we are, as an industry, very bloated. That means that banks are paying, in many cases, next to nothing on deposits. The likelihood of them beginning to pay more across the board is very low, in our opinion, for some time. Now, that's not to say that you won't find rate specials, but there is so much cash out there, and banks have very few good options on where to spend that cash. I can tell you it has caused many of our peers and competitors to get ultra competitive on loan pricing. They are locking in loans, very low rates, very long term. And if you sat through Dr. Lewis's presentation, that would be akin to buying long-term bonds. And we have elected not to do that in most every case because of the interest rate risk associated with doing that. Yes, it helps earnings right now, but 2 years, 3 years, 5 years down the road, there are real consequences. There's real pain that comes along with those short-sighted decisions. And so with that being said, we are in an inflationary environment. I mean, make no mistake, we are in an inflationary environment. And what I want to leave you with on the inflationary environment is that we have very carefully sculpted our bank's balance sheet to be ready for this over the last couple of years. We took the opportunity we had in 2020 and 2021 to develop a battle-ready balance sheet for our bank so that whatever may come in the way of inflation or potential growth opportunities or economic turmoil, we would be prepared to succeed. So let's go ahead and talk a little bit about those financial results. You heard me talk about our concern on inflation, and we're going to get to that in just a moment. First up, we have an overview of our assets over the last several years. I know this is a lot of data, but I thought it'd be neat to give you guys a little bit of a look back. It is Thursday, so we can do a throwback Thursday sort of feature. What did the bank look like in 2010? Well, if you look at our company in 2010, we had about $500 million in total assets. We had loans of just over $220 million, right? So that's kind of where we were in 2010. And the reason that matters is loans is obviously how we make our money, right? That is our asset of choice. We like to make loans and we like to get interest off loans. If you fast forward, the other point I'll mention is the red line is investments. So we had more investments in 2010 than we actually had loans, right? So you make a deposit, we can either lend it out, we can hold it in cash, or we can invest it. We like to lend it or invest it. As we fast forward to the end of the first quarter, and again, these results are all published. There's nothing proprietary here. This is an earnings release. You'll have seen the bank's balance sheet grow to more than $730 million. So we have grown by just a little bit more than half since 2010. Now, there are peer banks that are grown by many multiples of that, but we're very satisfied and comfortable with the growth we've had. At that same time, our loan portfolio has grown very significantly. Our loan portfolio as of the first quarter is more than $360 million in total loans. That's a growth from just over $220 million to $360 million. But the theme we're going to talk about here coming up soon is I want you to look at the investments. You'll see that our investments totaled about $250 million in 2010. And you'll see that number be relatively static, but what you're going to notice is a drop, a marked drop from 2019 onward. So what happened in 2020? Why did our investments change? Let's talk about that. Let's talk about that. This is probably the most impactful. If you're looking at our bank's asset mix on our balance sheet, you're going to see a radical change from 2019 to 2021. And it's important to talk about because this greatly influences earnings. This greatly influences our income, both now and in the future. In 2019, you'll see that we had loans of about 54% of our total assets. That's a little low by industry metrics. We would ideally like that to be somewhere in the 65 to 70% range. But what you're going to notice is cash and equivalents were 8.82%, and investments were about 30% of our total assets. Fast forward to year end 2021, cash has grown from 8.8% to more than 25% of our total assets. At the same time, our investment book actually shrunk. It shrunk from 30% of our total assets down to around 15. It shrunk by half. Why did that happen? Why would we willingly allow that to happen? Let's talk a little bit about that. The primary reason that we have stockpiled so much cash in lieu of reinvesting in long-term bonds is to mitigate interest rate risk. This single graph, and we'll come back to it as we talk about income, is a key one to understand because cash and cash equivalents for us earn little to nothing. Earn little to nothing. Just like in your bank account, I bet everybody in the room, you're not getting paid a lot on your bank accounts, right? Very few people. We're not either. But we judged it to be in our shareholders' best interest and the bank's best interest to sit on that additional cash, knowing that inflation was inevitable in the short term so that we could redeploy it in a way that did not have the same risk. So if we're looking at our income, and we're going to look at this slide again, we're going to revisit this in just a moment. You would have seen in the earnings release and in the annual report, we posted net income of just a little over $2 million for 2021. I want to talk through that a little bit at a high level and we'll revisit it. So first and foremost, if I were sitting where you are, I'd be thinking, Clayton, you know what? Merchant Submarine Bank has paid a consistent uninterrupted dividend for almost 80 years. I'm seeing income drop by half. Are my dividends at risk? Like, do we need to be worried? What I would tell you is that the reduction in income was on purpose. Again, the reduction in income was on purpose. Two primary reasons. One, we have made very heavy investments in our infrastructure to support additional growth. Every once in a while, you have to do that. You have to get new technology. You have to enter new markets to diversify. You have to hire new staff or start new business lines to diversify your revenue streams. We did that heavily in 2021. The other key factor that's influencing those 2021 earnings is the amount of cash that we've had on the sidelines that has not been reinvested. And again, the reason we did not reinvest it is to avoid interest rate risk. The other thing to note is that we did take an opportunity in 2021 by receiving one-time money from the federal government. We are a community development financial institution, a CDFI. There are only about 200 of us in the entire country that are banks. That means we have a mission-oriented focus on serving communities of all types with an emphasis on low income, middle income, moderate income, rural, underserved, marginalized communities. That's our jam. That's what we do. We want to serve those communities. And so that allowed us to get a grant from the U.S. Treasury that could be either used to bolster capital or to bolster loan loss reserves. And we said, you know what? We've got some one-time money coming in. Let's use that one-time money to fund one-time investments back into the company. And we did to significantly reduce the volume of problem loans we had as a company. So you'll see a little ad back there in dark blue. We did write off about $600,000 last year intentionally to remove problem loans off our books. And we'll talk more about that as we go forward. So to the topic of investments. What if we had taken all that cash in 2020 and invested it? For simple purposes, we estimate that we could have conceivably invested about $125 million of our cash and not needed it. We could have done that in 2020 or 2021, or we could do that now. And so what I wanted to quantify for you guys is the income impact doing across 3 different lenses. So we're going to see a little blue line, total annual income, light blue there. The light blue is what the total annual income would be for us had we invested $125 million into 10-year treasuries back in June of 2020. And keep in mind, all of our peers, investment advisors, everybody was saying, guys, you just need to reinvest this money. You need to invest this money, go long, rates are not going to go up, just reinvest. And so that is what we would have been looking at. We would have been looking at added income of about $800,000 per year if we had reinvested in June of 2020. Now, let's say that we didn't reinvest in 2020. Let's say we kept that cash on the sideline and we say, you know what, 2021's our year. We're going to reinvest in 2021. We're going to put that cash to work. Then you get to the red line, which is just about $2 million. So instead of getting $825,000 a year in added income, had we invested in 2020, we would have been able to get $2 million more per year in net income if we had bought the same securities, but a year later, June of 2021. Now, to Dr. Lewis's point, let's look at what it would look like today. Same $125 million that's sitting on our bank balance sheet. We could stroke a check today and buy 10-year treasuries. And if we did buy 10-year treasuries, as of the time this was put together back in late April, that income wouldn't just be $2 million. You're talking about $3.6 million in additional annual income every year if we bought $125 million in treasuries now. So when we say that we wanted to be disciplined, that we did not want to lose our heads, we didn't want to make a knee jerk, that we wanted to take risk off the table, this is the best way that I can show you that. So when you say, Clayton, are our earnings really in trouble? Goodness, it seems like we're going off a cliff. Our earnings are down. I would humbly submit to you this to say, well, if we wanted to, or if we thought it was best for the bank, we could turn on an additional $3 million in earnings overnight. But I will tell you that when you look at our loan growth, which we'll touch on momentarily, we have better uses for this sort of cash. The other thing I would share is that purchasing investments back in 2020 or purchasing them in 2021 had very real, or would have had very real consequences to our capital. So keep in mind, capital for us is incredibly important. We can't go below certain thresholds lest we be shut down by federal regulatory bodies. So it's important to note that in those same lines, if we had purchased 10-year treasuries in 2020 in an attempt to add $800,000 per year in income, we would be sitting on an additional unrealized loss of over $20 million. So let that sink in. That would be the trade-off. $800,000, but a $20 million loss value of those bonds had we purchased them. That's significant. Very significant. We judged the risk of that to not be a prudent investment. So that's why we held cash in 2020. As we got into 2021, the same sort of math. Man, it's looking better. The earnings, it wouldn't just be 800,000, it'd be, somewhere near 2 million. It's looking better. But we held off because of the inflationary concerns. Had we invested that same $125 million during 2021, and we had added a couple of $1 million a year in net income to the bottom line, we would still be looking at an additional unrealized loss of more than $10 million. Huge. And that's a very real factor that's impacting a lot of our peers. Keep in mind, we did not do this, and that's why. So if you're curious about why have we held so much cash for so long, these are the best 2 charts that we could give to help explain our rationale for that. We judged the added incremental benefit of the income we would have received to nowhere near outweigh the added risk of purchasing that income or purchasing those assets. So when we revisit our net income and you're looking at, gosh, net income was down by half, net income was only $2 million, I hope that you'll keep in mind the value that is sitting in the cash holdings that we have and the ability, if we can't lend it out, to literally redeploy that money in the form of investment securities and really begin boosting income in a meaningful way. Now, you should know, and we'll talk about it as a priority, we have slowly started reallocating some of that cash very carefully, very cautiously, and on a very short-term basis to minimize risk. In terms of income, though, let's talk about the other anomaly. I know that some of you are looking at the annual report and thinking, Clayton, have you lost your mind? Non-interest expense is up. Why are y'all spending so much money? What's going on? Net income is down, and revenues are down. If you're looking at investments, and expenses are up, what's going on? Let's talk about that. First off, you're correct. We did spend more in non-interest expenses last year than we have in prior years. But what's important to note is that while it may have been categorized as an expense, these were investments back into our company. Big investment number one was Canvas Mortgage. If you all remember, we announced that last year that we were launching a new mortgage division. We had almost a full year's worth of cost for Canvas Mortgage in 2021 as they were ramping up, as they were building infrastructure. We did start receiving revenue from that, and they are ahead of budget, but that's a big lift. That was an investment back into our company to diversify our income. Other big lifts that hit our financials from a non-interest expense standpoint very hard in 2021 were the expansions into Hattiesburg and the expansions into Mobile. So we announced those and completed those in late 2020. But if you think about this, they really came online only in the fourth quarter of 2020. We did not have our first full year of added impact of those salaries, of those new branches, of those new facilities, of all the additional technology licenses until we got to 2021. So when you're thinking about why are expenses so elevated, please remember that it was due to investments back into the company to position us for longer term growth. One of the highlights, and I do want to spend a little bit of time on this, just high level, is the improvement in asset quality. So as we have been working toward building a balance sheet that we consider to be battle ready, one of the things we realized is that our levels of problem assets, past due loans, non-accrual loans, non-performing assets were high. High related to peer, high related to where we wanted them to be, kind of like looking at yourself in the mirror saying, I'm going to lose 20 pounds. We set out to do that during 2021, and we made major progress. So if we're looking at longer term trends in things like 30 to 89 day past due loans, in terms of non-accrual loans or non-performing assets, this graph summarizes the trajectory of our less than desirable assets since 2010. So what you will see is a very concerted effort from 2020 onward to eliminate from our balance sheet the biggest problem loans, risky assets, and things that are not earning for us. You'll see those ratios drop very markedly from 2020 to year-end 21. And I wanted to give you some updated data as of the first quarter as well to let you know that our work is not done. We think we can still do more in the way of reducing non-current loans as well as non-performing assets and non-accrual loans. So hopefully this graph gives you a little confidence. It gives us a great deal of pride. Our team worked incredibly hard on that, from our market presidents, Jimmy Conyers, Mac Rushing, Grant Walker, our Chief Risk Officer, Jeff Trammell, our Chief Banking Officer, Greg Hodges. They worked incredibly hard throughout the year to make this happen. And they've instilled a lot of disciplines in their teams that will hopefully help us avoid ever having those same levels as we go forward. So that's a big bright spot for last year. So we're going to transition and talk a little bit about accomplishments as well. Beyond the numbers, we're going to talk about some non-financial accomplishments. And the team at Snapshot Interactive put together a little video. So I'm going to hit roll on this here. I'll let you guys take a quick snip of this video.
At Merchants and Marine Bancorp, we are committed to success. That's why we're always looking forward, so we can seize on opportunities that will ensure we capitalize on future endeavors. Our 2021 journey began with the launch of our new branding initiative, which better reflects our coastal roots, our core values, and our proactive client service positioning. Our Canvas Mortgage initiative has empowered a superior team of professionals with a collective 100 years of experience. Our Hattiesburg branch overcame a competitive market and a challenging lending environment in order to be successful in its first year. We also look forward to expanding our operations in Mobile, with a new downtown location opening soon. Across every division, Merchants and Marine Bank has hired and promoted team members who share our bank's vision. This comprehensive personnel initiative will establish a new standard in banking service and help foster long-term client relationships. We are investing in the future by incorporating heightened technology platforms, giving customers even greater confidence in our integrity and their banking experience. An expanded client support network reflects our round-the-clock devotion to client accountability and resolve in preparing for growth. The energetic, innovative, and enthusiastic spirit of our team is poised to lead Merchants and Marine Bancorp to a prosperous and enlightened 2022 and beyond.
So that being said, let's talk a little bit about this. Obviously, our branding is a little different. We announced that last year at the annual meeting that we were refreshing our brand. I know there were always, and there always are, you're rebranding. What's in it for us as shareholders? Why are we going to spend all this money on rebranding and change signage and websites and all that stuff? What's in it for us? What sort of value is that going to drive? Well, I can tell you that since this rebranding was launched in June of 2021, for every quarter since then, our bank has had consistent, sustained, record organic loan growth. We have. That's been a huge bright spot for us. We have grown loans organically, quarter to quarter, more than 10% on an annualized basis in each of the last 3 quarters. If you average all the last 3 quarters together and so what's that annualized rate of growth in loans, it's 16%. That is strong. That is strong for us. That is strong for our industry. I can also tell you that we have benefited greatly by the way of being able to recruit back office and upper echelon team members from being loan officers to operations team members. We have Lisa Fitzgerald somewhere running around out here. She's a new member of our accounting and finance team. It has really helped us from the lens of being able to attract talent. And at the end of the day, we're a community bank. We don't aspire to be a Wells Fargo. We don't aspire to be any other big mega bank. And in our model, people bank with people. People also work with people they know and trust. And so we had to create an environment that allowed people to be very proud of where they work, somewhere they felt connected, and somewhere they felt that was moving forward. So those investments are yielding real returns. The other large investment that we made last year, and I think it's a real bright spot for us, was launching Canvas Mortgage as a standalone division of our company. Canvas Mortgage was officially launched in April of last year after much work and much preparation, and is doing very well. They ended 2021 more than 15% ahead of budget. They've been very conscientious on their expense structure, and we are now at a place that the operational backbone for Canvas is fully built, and we're layering in mortgage originators, people that are actually adding volume and revenue with that. What's exciting to me about Canvas Mortgage is that we were able to build a mortgage company from the ground up, leveraging all the new technology. Sometimes you have to pay for the sins of the past. You buy an old house that you really love. We like to say, hey, it's got really good bones, right? And then what do? You set out to remodel it, and we're going to change this and move the kitchen over here. And you have skeletons in the closet you have to deal with. What's exciting about Canvas is we don't have any legacy baggage to deal with. Our team was able to build a best-in-class mortgage platform from the ground up, using all the latest technology, all the efficiencies, all the best of the best, everything today. And we were able to get that up and running last year. Now, one thing I know that may be on your mind is you're saying, Clayton, you're just saying rates are going up, and you just started a mortgage company. Is this kind of a bad time to be getting into mortgage? I mean, rates are up and people aren't able to refinance as much. And isn't that somewhat of a bad time to be launching a new mortgage company? I would remind you that Canvas Mortgage wasn't something that we launched because we wanted to jump on a bandwagon and be a part of a fad that was chasing refinances. We started Canvas Mortgage because in any market conditions, we judged that we needed a mortgage division. We need that. Our clients were demanding it. We were referring off a tremendous amount of business to competitors who were not only getting the mortgage loan we sent them, but then trying to claw away the deposit accounts or the commercial loans or other business ventures. The other thing I would say about Canvas Mortgage is it's important to remember we didn't build it on a refinance model. It was built on a timeless model that prioritizes purchase transactions over refinances. It was built on data from 2019 before. We excluded all the data from 2020 when we were modeling out our pro formas because we knew it was inflated with refinance activity. We knew it wasn't real data. So I would say to that I think the time for us to be in Canvas Mortgage is now. It's something irrespective of the market conditions was a right decision for us. We're very confident in it. And it will be something that as we continue to go through different rate cycles will help us de-risk our revenue stream. For instance, mortgage companies tend to be counter-cyclical to our commercial banking model. You think about when the federal government's lowering rates, they're normally doing that because the economy's in trouble, right? They don't just lower rates because the economy's doing well. They lower rates because the economy's doing poorly. What we've seen time and again is when they begin lowering rates, our commercial business volume dries up because all of our business owners are saying, hey man, I don't know if I want to expand. I'm going to go on the sideline. But what does ramp up when rates go down? Refinance of mortgage transactions. So even though rates are going up now, we know that there will be a time when rates do go down, and that refinance activity at that time, that heightened activity, will serve as a counterbalance for any declines we have on our commercial book of business. So you've heard me use this term a few times throughout the presentation, and it's a very broad term. It's what we consider in-house a battle-ready balance sheet. It's very important for us to remember that we make our money as a company off of our balance sheet. We don't really produce widgets. We don't build condos. We don't, run a county government for money. We take deposits and we lend those out. And so how we construct our balance sheet is critically important to us, and it's a direct reflection on our overall performance. You've heard me talk through a few items that are rolled together in this holistic initiative, things like improving our credit quality, getting all the problem loans out of the books, turning on the loan production engine so that we control our own destiny. So we're no longer just having to hope and pray for loan growth, but that we can turn that switch and get it day in and day out. What you've not heard me talk as much about that underlies this is the team that makes it possible. That has been a primary focus for us over the last couple of years, getting the right people together to execute on this strategy. This bank is far too big for me or Royce and I together to do anything. It takes a very highly skilled, highly driven team of professionals to make this thing work. And that has probably been one of our single greatest accomplishments over time, putting together a team that can execute on a comprehensive set of strategies that are moving our bank forward now and that will continue to move us forward for years to come. So that being said, we're going to get near the end of the presentation. Where do we go from here? What's on the horizon? What are we planning to do for the remainder of 22? And what are we looking at beyond? Let's walk through this a little bit. First and foremost, organic loan growth. We are still on track to have strong organic loan growth going forward. Again, the market presidents who I mentioned earlier, their teams, our chief banking officer, Greg Hodges, have done a wonderful job developing a team that is capable of growing loans consistently. These aren't loans that we're going out and giving cut rate deals to. These aren't loans that we're undercutting competitors on by the rate by 25 basis points. These are whole relationships we're moving over. That's a continued focus for us. That's a huge key to our success. If we can continue executing on that, our profitability potential is through the roof. While it sounds good to say, hey, we could add an additional $3.6 million in income today if we bought 10-year treasuries, the amount of added income we would add today if we deployed $125 million in loans will be double that. So that is our focus. And the fact that we have been able to execute quarter after quarter after quarter gives us great confidence we'll be able to continue executing going forward. Another key item, and you've heard us discuss this, is executing now that rates are factoring in inflation, a very prudent redeployment of some of our excess cash. You've seen the income potential. I can tell you we're not going to swing for the fences and make an ill-sighted move and buy $125 million in 10-year treasuries. We're not doing that because that would not be a prudent use of your money as a shareholder. It would not be a prudent move for us. That would lock us in long term. But we are exploring and we'll begin enacting a very disciplined, regimented approach in deploying some of this excess cash, getting it off our balance sheet where it's doing nothing and putting it to work to drive value for you. That is forthcoming this year as we go forward. Another key item that we're focusing on is ramping up Canvas Mortgage. The foundation has been laid. The operational backbone of Canvas Mortgage is strong. We have everything we need to bolt on the best and brightest mortgage producers to help people realize their dreams of home ownership. I mean, that's an exciting time. We're also likely to benefit in Canvas Mortgage from many of our other mortgage competitors having to now furlough staff. Y'all have seen that, you've heard that. Wells Fargo's announced a 15% cut in their mortgage staff. Other banks and other mortgage companies are doing the same thing. Anytime there are cuts or furloughs, it unnerves everybody. Even the top producers, they get scared. They're losing their friends, they're losing their comrades. It's a great opportunity for us to offer a compelling alternative where they can go work for a mortgage company that is run like a real mortgage company, that's not run like a bank that's going to make arbitrary decisions, a big bank. Another key priority for us is continuing to pursue operational excellence. I know I've talked about this a lot over the years. But it's important to know that those top producers, those A-talent players, rock stars, whatever you want to call them, they only want to work in environments where they can be successful. They want to work in an environment where they know that there's a backbone there to support them, that they're not going to come in and be the star player on a team that doesn't have the budget or a team that doesn't have the resolve to help them be successful. So when I say operational excellence, I'm talking about creating an environment that we can continue attracting A players, top performers to help this bank win. That's a top priority for us as we go forward. And in doing that, help our clients have a better experience as well. The last one is really going to focus on the team, the bank family. It is a very tough environment to hire, to develop, and to retain team members. It is. We're in the midst of the Great Resignation. Y'all know the stats. You know that 80% of the people in the country say they are considering changing positions. 80%. We know all the stats on how hard it is for our industry to backfill the open positions we have. So our approach is we're the absolute best we can to recruit the best and the brightest, to train everybody that we have. We're going to make them better bankers. If they come aboard here, we will teach them to be a better banker. We know that we may lose some, and that's okay, and that's happening. We're actually at a place that people are now seeking out our talent, bankers that we've built, and they're seeking them out for other companies. They're giving them promotions and hiring them off. And on the face, you're thinking, man, that really stinks. And it does. It hurts. It sets us back a little bit. But it's also a huge compliment to this organization to say, you know what? Merchants and Marine Bank builds some of the best bankers on the coast, and they build the kind of bankers that larger competitors want to steal to come run their bank. That's a compliment for us. And that's the sort of legacy that will always attract the best and the brightest to want to be a part of this team. But we are focusing very heavily on making sure we take care of the bank family that we have, that we invest heavily in them, that we give them every opportunity we can. And if somebody leaves us, and sometimes people do, we're going to celebrate them. We're not going to be angry. We're not going to, cut them off or delist them as a friend on Facebook or Instagram. We're not going to do that. We're going to be proud for them. We're going to celebrate them. We're going to cheer them on, because we want that next person who is following them to say, you know what, that's a really cool company. I can't believe they're wishing them well on LinkedIn or Instagram or Facebook. I want to work there. That's what we know. We're playing a long game on that, just like we did on the investments. Last and certainly not least, I do want to give you an update. As you guys remember, we had a special shareholder meeting last year. The cost of that coincidentally also escalated that non-interest expense figure. We have qualified for funding under the Emergency Capital Investment Program. Again, we're one of 200 banks in the country that are CDFIs. We have qualified for somewhere north of $50 million from the government. This is the money that Dr. Lewis was talking about earlier. Again, the basic tenets of this is non-voting, non-cumulative, perpetual preferred stock. Basically what that means is it is an interest-only loan in perpetuity from the federal government. The lifetime maximum rate on this is 2%. That's the max. It will never go more than 2%. And we may actually be able to lower the rate if we continue doing what we do, and that is lending into communities that are distressed, that are underserved, that are rural, or that are low to moderate income. And we do that anyway. That's who we are. That's our DNA. So you should know that we are planning to close on these funds in June of this year. We don't have final details on the closing. Y'all know how sometimes the government is. They want you to hurry up when you're on their schedule, but then they're perfectly fine letting you wait a little while on them. So we are in the process of getting final documents together to close on this program. We do think this is going to be a tremendous catalyst for our bank, to be in a place that we can control our organic loan growth, to be in a place that we are able to attract really good quality bankers and begin building our own, to know that we have somewhere north of $50 million in subsidized capital coming to bear that we can put to work for you. That's a great value proposition. And so we're excited to get that money. The only thing I'll say is I know there's always concern about, well, gosh, you're dealing with the government. I would say we deal with them anyway. By law, we have to maintain federal deposit insurance. They give us our license to do business, so we are dealing with them anyway. But the terms of this could be truly transformative. There really are no negative shareholder attributes here. We have to adopt policies that are shareholder friendly, like, hey, you can't have excessive executive compensation. We don't have it. It's not who we are. But we'll have policies prohibiting that, policies prohibiting excessive or luxury expenditures. There are restrictions on stock buybacks beyond a certain threshold. They highly limit those, because the purpose of the program is not to line banker pockets. The purpose of the program is to give additional growth capital to banks like ours that are making an impact in the communities we serve. That's the purpose of this, and that's how we plan to use it. So with that being said, I know we've run a little long. I would love to take any questions and answers, or provide answers. And if they're really hard questions, we may punt to Royce. I'm just picking Royce. We'll take them. But with that being said, Casey, do you want to join me up here, and we'll tackle some Q&A, and I'll grab a chair as well. I don't know, man.
Okay. So we're going to run this in the same format that we did the previous session. If you have questions, please text them in, and we'll get them in the queue and answer them to the best of our ability. I think we've got about 10 minutes, 12 minutes.
And I will say, in addition to that, while we may only have 10 minutes for purposes of this, because we do have additional organizational work to do after this, please, 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 if you have questions that are not addressed here, you get my card, Casey's card. Please connect with us after the meeting, over lunch. Rest assured, I know I've had the privilege of interacting with several of you out in the audience. We're not going to shy away from hard questions. We like hard questions, and we want you to have real answers to those questions. So ask away.
Got a great start, considering that we've got some more youthful attendees this year. Since we have some high school students observing today, what is your best advice for a soon-to-be college student, financial or otherwise?
That's a really, really great question. I guess few pieces of advice. First and foremost, I've had a few near misses in college. I thought that there were a couple of positions that I may have wanted to do. One of those was to go in a different industry, and I was doing that primarily because of the money. I saw dollar signs, right, and I was like, oh, this is gonna be great. I'm gonna go suck it up for 8 years and get an MD or get a DO, and I'm gonna be a doctor. I'm gonna make tons of money. And I had a really great mentor that said, you know what, I don't think you're cut out for that, Clayton. I don't think that's who you are. You're doing that only because of the money. I would have been miserable. So that's number one. Please, please, please don't be lured by the money. Number two, another huge piece of advice would be take the opportunity to get experience, even if in some of those positions they may not be at the level that you ultimately want to be at. Maybe if it's a junior level position, take the opportunity to get the experience and know that your willingness to work hard and outshine your coworkers will always show through. It will always, always show through. We see that in the bank. I'm looking at Parisha Coleman. I know she and David Thomas lead our retail division. It is easy to spot star performers because there are not that many of them. A lot of people come to work and they treat it just like a job, and they clock in and they clock out, and they work a little bit in between. But if you really want to be successful, outwork and outshine the folks that are around you, it always pays off.
Great. We've got a question. I want to preface this one. It starts out, any forward guidance. So anything that's said after this question is asked should be viewed as just forward guidance, no warranties implied with that. It should not be used to make investment decisions. As Dr. Lewis warranted in his last one, we're not in the business of predicting the future. We're in the business of responding to economic scenarios to the best of our ability. So with that said, any forward guidance on how and when macro conditions will influence net interest margin at Merchants and Marine Bank?
That's a really good one. I would love to give you a very straightforward answer on that and say, goodness, rates are moving up and we ought to be able to reprice our loans much faster than our deposits. We're hugely asset sensitive. What that means is if you're looking at our balance sheet, we have the ability to reprice our assets upward with rates quicker than our deposits will reprice upward. And that's typically a good thing. What complicates that and what we're seeing today is that even though rates are moving up, our peers still have so much cash that they're sitting on as well. And they're so desperate for any earnings that they can get above and beyond a treasury yield. And so what we're seeing is very unique and aggressive loan pricing. And so that has been the primary hindrance to us improving our net interest margin from a loan side. You should know that our bank has very intentionally reduced exposure to more costly funding sources as well. Over the last couple of years, we've exited bid term municipal deposits. Our last bid term municipal deposit will roll off at the end of June. Coincidentally, that single account that's going to roll off in June accounts for about 2/3 of our total cost of funds. One account. accounts for 2/3 of our total cost of funds. And when that one account rolls off, the lift to our monthly net income will be somewhere north of $100,000 per month. Again, one account that's off. And so that's another reason we've held back a little cash to allow that to roll off. So while we're confident we will see expansion in our net interest margin due to those factors, we are battling pretty stiff loan competition. And the other thing I'll say too is that our Fed fund balances are factored into that net interest margin. That's the other thing to keep in mind. So you're seeing all that cash. That's a very low yielding asset. So that is compressing those margins as well. So just keep that in mind.
Absolutely. And as a follow-up to that, we've seen rates getting thrown out there right now that are no higher than the equivalent U.S. Treasury rate, which is mind-blowing to me from a risk standpoint. Regarding options for using your cash, is Merchants and Marine Bank considering share buybacks since price to book is low?
That's a really great question. You should know we've had extensive conversations internally about the possibility of share buybacks, and there are lots of viewpoints on share buybacks. What I can tell you is that while a buyback may lead to a temporary improvement in earnings per share just based on the way we calculate the math, we judge that we can add stronger growth in earnings per share by retaining that capital and putting it to work and executing the growth plans we have. We built a back office that's capable of almost doubling the size of the bank, right? So we built a back office far more robust than we need for a current asset size in anticipation of growth. And as we model it out and we put buybacks on one side and we put the opportunity to hold on to that capital and use it in meaningful growth, it always pans out that that's the better use of those funds is putting that to work and growing the bank in a meaningful way rather than just using, and I hate to say financial engineering, but using some system just to change the math rather than leading to a sustained improvement in the fundamentals. And that's what we're after. We're after a long-term improvement in fundamentals.
With interest rates up and inflation trending that way as well and likely continuing, how will the bank handle upcoming municipal funds bidding?
Upcoming municipal fund bidding, we will likely be very cautious on bidding. I would suspect that while we may turn in bids here and there, we will likely not be very aggressive in those bids. And again, simply because we have nothing really to do with those funds. Sitting on as much cash as we are, we're confident we can either lend out most of the cash, we can allow high cost deposits to roll off, or we can invest some. We just hate to change that mix a whole lot more with higher cost municipal deposits coming in. If we do bid, to sum that up, would likely be very conservative and lower rates bid.